Good evening, everybody. We'll start in 20 seconds, 19, 18, 17. Nice to see everybody coming out tonight. Got a good registration count. Usually what happens, the market starts getting hit. Good evening, everybody. Welcome to the market strategy session for the week of January 11th, 2016. Of course, tonight it's January 10th, and I'm joined with my partner in crime, Mr. Paul Schatz. Let's go over the economic reports real quick, then we'll get right into market talk because there's a lot to wax poetic on this evening. Nothing Monday. Tuesday, Fisher very early in the morning, then the JOLTS job openings at 10 o'clock, crude oil inventories on Wednesday, weekly unemployment claims on Thursday, Bullard speaks, import prices, all pre-market, the Eurogroup meetings, and you got the ECB monetary policy meeting accounts. On Friday, lots of good stuff. Got the ECOFIN meetings. You got core retail sales, regular retail sales, PPI, core PPI, Empire State Manufacturing, Dudley, capacity utilization rate, industrial production, and preliminary University of Michigan consumer sentiment. That's 4 red reports. Only one of them during the market day, though. The rest are pre-market. So, unless you missed this past week, I don't know if you really have to live under a rock to miss it. Maybe you were away doing something fun and you decided not to pay attention to the market this week. But by now you've probably seen the worst start ever to a year. January effect, poof, did not happen this year. Instead, small caps led the way to the downside, as per the Russell. Yes, there were some stocks that were outperforming, that have held up in the face of this slaughter, but a lot of the quote-unquote brand names that everybody is used to looking at, stocks like Goldman and Bank of America and Amazon and Apple. I wrote a great article, if I do say so myself, on Apple. Great meaning that I quoted some outside sources, and there's a nice video from Paul on there as well. On the blog, paulandsaul.com/blog. You can read all about where I think Apple is going to. So there's a lot of blood in the streets. The real question on everybody's mind is, is this telling us that this year is going to be an ugly one? Personally, I think it's way too early to make that determination just based on the first week. Paul may disagree, but I kind of don't think he does. So for us, I really am not focused on how we're going to end the year right now. I want to be focused on what we're going to do from here. When is the selling going to stop? When could we potentially see a floor come in that at least can get us a bounce? So I'm going to turn it over to Paul. He's going to go over the indices and his opinion. And you have any questions? Let him know. Are you set as an organizer? Yes, you are, right? So
I am set. Yep.
Okay. And when you get it,
what are we doing at the end? Am I?
Yeah, no.
Are you coming back or?
No, I'm going to be here, but you have to text me because I'm probably going to be muting the conversation while I'm finishing up stuff for the inner circle. All right.
Good Sunday evening. Hope everybody enjoyed the wildly volatile week. If you didn't, like I didn't, then there's 51 weeks left in the year. Actually, you know what? I gotta hang on one second because there's a couple of things I keep forgetting to write down. And if I don't, as I talk, I'm never going to remember. I do not have a cold. I have a wicked allergy attack that started yesterday in Vermont, so I apologize if I'm going to sniffle and probably need some tissues for a while. But I've taken 3 different allergy meds last night and today, and they ain't working, so no, but tomorrow it shall be gone. Let's see. 1 sec. Okay. So my setup here. Yes. All right. So let's start with where we are, and then let's go backwards. Stock sold off sharply last week. Something that the sharpness aspect, I absolutely did not expect. That last week was extremely painful. Mostly because I didn't expect it to come, and I don't like reacting. I'd rather be proactive, so that wasn't really possible. But we'll walk through the week in a second. Where we are now is, obviously, on most measures, we're really oversold, and a bounce could come at any time. What I wrote Friday, I think, was that Friday was probably the easiest day to do anything, because the gap up was a joke. So that was only for me anyway. That was the only easy part of the week. And once we lost Friday's gap, the big open, markets don't bottom on Fridays. So I think there's historically there's an 11% chance of a market low on Friday. And from my memory, I did not go and test this, but I vividly recall that the low after the 9/11 market opening was a Friday. I vividly recall that because it was one of my bachelor parties, and I was in Wisconsin playing golf with 7 other guys. And I woke up and the market was down 600 points. So I vividly remember that, and I remember the first week of April, 1997, bottomed on a Friday, as well, because I was skiing in Vermont with a woman I was trying to date, which did not go very well. And I remember missing the market bottom that Friday because I was skiing. In any case, there aren't a lot of market bottoms on Fridays. So Friday was easy. We are really stretched on a number of measures. I think in all likelihood, there will be some type of low this week. And before the low comes, you can't say, well, this is the long-term low or whatever. You just can tell there's a low coming because of the acceleration of the decline. So right now the futures are down roughly 0.5%. For the market's sake, if you're looking for a low, then you'd rather see an uglier opening. You'd rather see a down, 200, 300, 400 point opening that makes headlines, rather than this meandering about after such huge volatility last week. So we don't have that. I think we'll probably put in a low this week and put gun to my head. I would say it's 16,000 or below, and then we'll go from there. Because of last week's decline, I have a couple of scenarios that opened up that I never thought would open up, and that is not that I can certainly see, but the research that I use suggests in a worst case scenario that after we bounce, however far we bounce, whether it's a day, a week, or a month, if the bounce is really poor, let's say we bounce from 16,000 to 17,000 or 16,000 to 16,700 or 8, whatever it is, we could see some kind of trap door where we go right through the August lows and then drop another 1,000 or so points in short order, maybe even a little more. That'd be probably the worst case scenario I'm looking for. Before somebody asks, there's nothing that's happened so far that cancels out my upside target of Dow 20,000. Nothing. So that's still going to be So my targets will be, the first target will be all-time highs, and the next target will be Dow 20,000. It's just right now, it's hard to believe that'll be on my timeline, but we'll see what happens if and when we bottom this week, and then we'll go from there. So, something else I wanted to mention. What the heck was it? Great. You know, when markets are volatile, what do I want to say? There's always so much to write about. So I wrote a newsletter Friday, and I had so much, so many topics, I couldn't fit it all into one newsletter. But I'll toot my own horn, which is kind of nice. So here's an article in Forbes that's going to, I think, get posted. Oh, got posted today, which I got quoted in at the end of the article regarding my comments that, here it is, right, so my comment is, this is, so for all the people out there who, like, I heard, what's the idiot's name, George Soros, who said this is 2008, this is nothing like '08. I mean, corporations got $3.5 trillion in cash, in '08 they had nothing. The system had 30 to 40 to 1 leverage. There's almost no leverage now. '08 was a systemic economic financial market system event. This is a market event. This is not an economic event. This is not LIBOR blowing out. This is not commercial paper seizing up. I mean, the banks are so stingy with their money. They got plenty of money. So we're not going to lose Wells Fargo and Citibank anytime soon. And then the other one, which I'd love to see, USA Today got me. And they just reprinted a whole thing for my newsletter, which I'm shocked because they never do that. So they must have ran out of smart people to call and called me, or they looked at my stuff over the weekend. So that was kind of cool for me anyway. And so let's dive in. All the charts of the major indices, some are weaker, some are stronger, but they're going to all look the same for the week. All right, and that is, you're going to see, Monday is what I call the gap of recognition, when you go, uh-oh, this is not in the norm if we're just in this kind of trading range, which is going to blow back out to the upside. So the gap of recognition was Monday. That's the uh-oh. And even after Monday and Tuesday's close, I thought, all right, crummy first day. The second day of the year is usually a good day. Well, guess what? It wasn't bad. It was essentially unchanged. Okay, not the worst thing in the world. Wednesday, we gapped down. We ended where we gapped. So, all right, not the end of the world either. Starting to roll over, but maybe Thursday the Bulls can play catch up, and this is the day where you go, if you're a Bull, you go, oh no, where they just stuck a dagger through your heart. And then this kind of day on Thursday, you got a lot more downside coming. Friday's day was, the opening was a joke. I'm not surprised we were ended down Friday. We sold off more than I thought we would, but clearly you can't be surprised. The opening was a mess. So where are we now? We're right here. Close at the low of the day. Friday's the only day that looked really ugly on a chart. The rest of the days didn't look that ugly because everything happened at the gap. So as you can see, a lot's happening overnight, and guess what? A lot of it's coming from China. I need some water. Although China's going to get blamed for all this, I wrote it in my piece Friday. This is not China's fault. The Chinese news may have kind of accelerated and exacerbated the decline, but the market was not trading strongly and healthily for a while. So the fact that it finally just gave up, you can't just blame on China. The Chinese market, to me, I think I've mentioned it before. When a major Western market's down 50% from the highs, I think you can buy a little bit as a long-term position. We're not there yet. I want to see the Chinese market be trade below 2,900 in some kind of little mini. Maybe get a big crash. Doubt it, but maybe get 1,000 points. It feels like a 300 to 500 point down days coming in China, and that's when I'd probably buy some Chinese market for my kids. We're not there yet. Our market looks like we got more downside to do. Here's the Dow trading probably better than some of the other indices, but not trading well. 16,000, we'll put it down here, maybe somewhere in this range before we get a bounce. If we just somehow come in tomorrow morning and we're gapping up big, wherever this bounce goes, I think you can short it and then for another move lower. But right now, if we don't bounce, we're looking at, I don't know, 300 to 500 more Dow points in the downside to get us a bounce. S&P looks very similar. So you look back down in here, the 1880 mark, we're at 1910. You're not going to see divergences set up yet because this is the first leg down, the first real leg down. These are just, I guess if you're an Elliott wave, which I'm not, I think it's kind of hocus pocus. These are like, waves, one and two waves down. This is the wave 3, the big strong one. Let's see, mid caps and small caps. The chart looks a lot worse than the others because they were lower to begin with, and they broke the October lows. So, but the same thing, we're looking at a couple more percent down at a minimum. It'd be interesting to see this wacko August day where a lot of ETFs blew out on the downside. It'd be interesting to see how if price acts as a magnet, because these prices kind of sort of weren't really real. And IWM, same thing. It was lower to begin with, and we just broke the August low and the October low on Friday. It was an ugly day. So, the Qs. And the Qs look a lot better on the chart. Look a whole lot better on the chart than the rest. Don't look nearly as ominous or beaten up, but they're certainly in the same percentage decline, I think, which is now about 7-ish%. If somebody asked you blindly, how bad is the market down? People are calling me saying, what are we down, 10, 20% already? And that's because the gaps are so big and it feels like it's a whole lot worse than it is. 7%, well, nothing to sneeze at. It's still not even a full-fledged correction. So those are the indices. Here's Europe, which, no surprise, we've talked about this for a while. What the heck is this? Is this a bottom that we can look to trade out of? Too early to tell. Well, the bottom fell out. So Europe's got some more work to do on the downside. Last week and the week before, I mentioned a lot of triple bottoms, and I said triple bottoms typically don't hold. Triple tops typically don't hold. So you're seeing a lot of the stuff that we talked about blow out towards that way. So here's Europe and emerging markets. Just broke the August lows. I'd probably be most interested in looking at the emerging markets if they get a bottom. They're so stretched already. There's no bullish sentiment at all. So whenever they bottom, you certainly could get a much sharper snapback short covering rally than the other indices because they're so beaten up. It's a couple of China ETFs. Here's one, FXI. Again, it's not. We're getting close to a spot I want to own it longer term, but not yet. PGJ, not even close. And I went through all the country ETFs. I'm not going to run through them all because they all have a lot of similarities. They're all kind of falling off the right side of the page here. So I'm happy to pull them up under question, but I won't go through them right now. Let's see. So that is that. Let me pause and look at the questions, and then we shall go into sectors. Questions out. And those of you wondering, the crushed hood of my car remains crushed because now I got to battle the other guy's insurance company. So I've been driving around with a crushed hood, and my son and I took it to Vermont. We're skiing finally yesterday morning from 7:45 to 10 o'clock was like midwinter conditions. It was beautiful. We got 2.25 hours of beautiful skiing before the fog rolled in and a frozen cloud rolled in, and then it got warmer and blah. I mean, I poured today, but I came home last night. All right, let's see. Here are the questions. Paul, would you say that the real line in the sand would be the August 24th low, and if that's taken out, the stock market could decline much further? Burwell, I am not going to say that. First of all, because the small caps have already broken. That's one. The mids, and I ignore this tail over here, because the mids have already broken it too. S&P, the lows that really matter, I think, are the closing low of October 25th and the whatever this one, September or whatever this date was, or October 2nd. I can't remember the date off the top of my head. If we come down here, so if we come down to the lows, I can see a scenario where they hold just above the lows and then the market snaps back really hard, in which case you can short it. I can see another scenario right now where they go to the lows like you mentioned and we knife right through them and have a kind of a capitulation move to the downside. I don't have an opinion on what would happen yet. But of interest, I had Fox Business and CNBC on Thursday and Friday, and I did not hear a single person saying to buy the dip, which really, really surprised me. Not a single one. So, for what it's worth, we still have further to go on the downside, but if we put in a really good bottom, it'll be interesting to see if we could surprise a lot of people and have a really hard snapback. Too early to tell, but let's see if and when we bottom and how we bottom. Let's see. The question is, do the FANG stocks look similar to the Four Horsemen of 2000? Yes, they do, but the however is, if you overlay them, the FANG stocks, Facebook, Amazon, Netflix, and Google over Microsoft, Dell, Intel, and Cisco, the FANG stocks have multiples more to go on the upside. They haven't even gotten there to 2000 yet, if that's a real analogy. But I do see similarity price-wise, just not speculation-wise, because in 2000, I mean, there were mechanics that were trading it during the lunch hour, and I had a lot of friends that quit their jobs and became day traders, and we all know these ridiculous stories. I don't think we'll see that again. And I'm 49, so I may see it in 10, 20, no, not even 10, 20, 30, 40 years, but no time soon. That the 99 2000 peak was the most reminiscent of the 29 peak. All right, let's see what else we got. What we've seen so far. Oh, I got a comment right down. What we've seen so far, we have dropped twice the gap of Monday's. Wait, Mike, I'm sorry, I don't understand that. Wait, why so? All right, Mike, type the question again. I don't follow the question. And then I'll be happy to comment or respond. What is your view on upcoming earnings season? So the typical trend is, however you run into earnings season, you reverse during earnings season. So the fact that we are collapsing into earnings season suggests that the market bottoms during earnings season and rallies. Somebody's going to say, well, what happened in 08? Well, in January of 08, we came in, we collapsed into MLK. I believe we bottomed on the Tuesday after MLK weekend in 08, and then we had a pretty solid 1 month rally before we put in the secondary low in the middle of March of 08. So just based on earnings season, you'd look for the trend to continue early in earnings season and then to put in a bottom and reverse. I mean, some of these financial stocks have just been absolutely obliterated, and they're going to report early. So what you want to see is watch some of these banks that don't have great earnings if they rally on bad earnings. That'll tell you something that the market's changing. Let's see. Okay. You said it's a market event, not a systemic one. Can the distress in oil companies turn to something systemic? Gunther, not in my opinion. Systemic stuff happens when the financial system breaks. And it typically breaks not because of losses. Anybody can withstand losses if they're not leveraged. So let's say oil went to, I don't know, $25 a barrel, which I've been wrong on oil. So let's say it went to $25 a barrel. Who does it really impact? Well, as consumers, we win. The oil companies lose. But you got a company like, Exxon and the biggies have so much cash in their balance sheets. At some point, they're going to start gobbling up these small companies that can't withstand oil being low. So I don't think it's going to spill over. You have to remember the biggest risk to the economy is not mom and pop. It's the banks. So if the banks start to collapse, that's the problem. They have $2 trillion in cash. So, and they haven't had any write-downs yet. So even if oil collapses further, there's just not enough oil companies who are going to be in distress that I think it turns into any kind of systemic event. I mean, systemic events look for spreads to blow out. Look for LIBOR and commercial paper, all that stuff. You don't even have any stress there whatsoever right now at all. So this to me it's a market event. Now listen, the crash of '87 was a stock market event. The economy never missed a beat. There was no systemic issues, nothing global. That was a market event. In one fell swoop, we took out the low of '87 or '86, I think. And then what happened? We turned tail, if you remember, on December 4th of '87, and 2 years later we're at all-time highs again. So let's see. Why do we have such violent reactions at 8:15 when China resets their reference rate on the yuan? Johanna. So the problem is, as you said, China is resetting the rate on the yuan. It's not, Johanna or anybody else, they're still not free floating the currency. So, China is the second biggest economy in the world, and things are happening because some grand wizard's pulling a lever and saying, here's what the yuan rate is. And because things are so volatile, it's forcing companies all over the world who do business with China to have that huge uncertainty unknown. So it's unfortunate. Eventually, China's going to have a free-floating currency. China's experiencing the growing pains of capitalism. Write that down. That sounded good. Like that show Growing Pains, and I was growing up with Kirk Cameron and his sister. What was her name? I can't remember. That was a good show, Growing Pains. Alan Thicke was on it, and his hot wife. In any case, the Chinese are learning the hard way that you can't manipulate, and you can't manipulate your market and debase your currency to prosperity. It doesn't work. But they think they learn from our experiences and can do that. It ain't working. All right. Based on the market decline on Friday, in light of a very good employment report, is it possible that the market is now not interested in employment data and alike money supply year over year? So keep in mind that the geopolitical stuff trumps, in a sense, it trumps everything. The employment report, while was a lot better than expected, beneath the surface, from what I'm told, I'm not an economist. I don't read too deeply into it. The U6 rate was unchanged, so that's the underemployed rate. Still, it wasn't bad at 9.9%, but from what I'm told, the reason we blew out to the upside on the employment rate was because of seasonal part-time workers, supposedly, and so the quality of the jobs wasn't there. And when you have a lot of part-timers hired, they can just as easily be laid off and not, so you're back to square one. The big piece for me was the participation rate went up. And that's a trend. We were at, what, I think 30 or 40-year lows in the participation rate. Now that's turning up. That's certainly a mild long-term positive. Just remember, at least from memory, I think the employment report in January of 2008 was also really good, because employment is definitely a lagging indicator. It's not a leading indicator. It's a lagging indicator. So at the end of a bull market, or literally the very end, it'll still look good and the market's collapsing. Do you see any illiquidity event, a major institutional failure, bank, third-party, country? Not here, JN. You don't have to leverage to see Wells Fargo, Citi, JP. They can certainly go down and go down more, but to have counterparty risk, what we saw in 2008 was not seen for 80 years. And the fact that we're all remembering it, I don't think 2008 is going to happen again for at least another 40 years, 30 years, 50 years. We could have a bad down years in the market, but not like 2008 where you have a financial collapse. Our system is in so much different shape than it was in 2008. You can't compare the two. All right, let's forge ahead. These are all good questions. And I say with a chuckle because I just hired, we were interviewing for a camp director at a camp that I'm on the board on. And during one of these Skype interviews we have with a candidate, every question somebody asked for 45 minutes, he kept saying, "Great question, Paul, great question, great question, great question." So we all kept laughing. In any case. All right, let's go on to the sectors. And again, I'll go them quickly because a lot of them are going to look similar. And as you're having this mini elevator shaft decline, a lot of stuff's going to look the same. So here are the semis. Semis looked good, for me anyway, right there last week. And on Monday, when they declined down here, I was in the mode. Not a bad trading day for the semis. If they hold here, they could launch right to all-time highs. And then Tuesday, I'm like, that's not good. And then Wednesday was terrible, and Thursday, blah, blah, and Friday. So that's how quickly, for my book, the semis went from looking really good to crummy and market-like. Software, same thing. Talked about it up here that they just made an all-time high here, and they had a hold somewhere in here in the 102, and we could see it move to 108. Well, guess what? Same thing. Monday's action, not bad. A nice little hammer, stopped out everybody down here, all the bears, all the bulls, stopped everybody out. Oops. Tuesday and Wednesday, not bad. Not bad days. And then Thursday was the day of, oh no, for the bulls. Boom. And then Friday was death. Telecom, same thing. They looked a little worse coming to last week, and they sold off a little worse. Internet, which I own, and just killed me last week. Absolutely killed me. So again, I wasn't feeling so bad coming into the week, and then Monday, all right, bad day for me, but nice little hammer. If we hold, maybe we can close the gap and then stretch this trading range on. Tuesday, all right, not the greatest day. Wednesday, not so good. Thursday was the disaster. And Friday was Friday. Again, a lot of things looking the same. Financials, Friday was the real shot. Thursday and Friday were huge declines in the financials, right ahead of earnings. So again, if you see any of these banks report bad earnings or bad guidance and they start to rally, that's going to be a sign that you want to hop on board the financials and the market. Banks, same thing, look terrible. Nothing even to comment on. And all of these on the surface would say, if you just bounce randomly, you could short a bounce. My guess is that I think everyone's talking about shorting the bounce. The bounce ain't going to come. We're going to go right to wherever we're going on the downside and then try to bounce. Consumer discretionary, same story. Looked like that before the week. There's Monday, okay. Tuesday, hung in. Wednesday, Thursday, boom, death. And Friday was death. Retailers have already been crushed. So what you're seeing the last couple of days, before Friday, they didn't look so bad because they're down so much already. Builders really got smoked last week. So they're way, 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 way buried. Thursday and Friday, the death days. But there's nothing really to glean yet from a lot of this stuff. When you close low tick of the day across the board and it's a Friday, it's really high. I know I can't do it. I cannot just step in and say, you know what, we closed low tick, I'm going to buy and hope. I'd rather wait and buy a gap down Monday, or I'd rather wait for it to reverse and pay a higher price than just start looking at some of this stuff as buyable. And because we sold off so hard last week, it's really hard to get short into that kind of weakness. Industrials, same thing. They all look the same. Basic materials, guess what? Looks kind of the same. Energy, XLE and OAH, not as bad last week, believe it or not. Why? Because they're already obliterated from the last couple of weeks and couple of months and couple of quarters, etc. So here's XLE. Doesn't look like it got crushed like the rest of the stuff did. And OIH, kind of the same. Last week we talked about this triple bottom. And what I said was, it'd be nice to get a little rally in this, maybe to get a short on, because triple bottoms rarely hold. Well, we didn't even get a chance. It just boom, boom, boom right away. So, not in there. Trannies. We already know they were death for a while, and they were death last week. Interesting. One of the reads I do, Rini Yang spotlighted, I think it was Rini Yang, that you got the trannies and you have gold and crude at new lows, 52-week lows. And historically, except for the October of 08 period, when the trannies and crude oil are making new 52-week lows together, you've only seen major bottoms in the stock market. So, interesting point to note. We'll see how it shakes out sooner than later. The airlines, same thing. Nothing really to glean yet. Let's see. Defensive stuff. REITs, guess what? The REITs sold off. Now, here you get a group that really outperformed. We looked okay coming into the week. Monday didn't do any damage. Tuesday was huge up in the REITs. Wednesday, inside day. Thursday sold off, not so bad. Friday was the only really bad day, but the REITs are trading really well right now. And they're a defensive group, as are the Utes, which traded really well as well. Utilities essentially closed the week unchanged. So unlike 08, where nothing was hanging in and everything was being sold, you got two groups so far that are resisting the selling, the REITs and utilities. And finally, you have the staples, which I own. It traded fine until Friday, and last week was not bad at all. and they just made a new high in December. Friday was a bad day, but it's still, so you get the three defensive groups are the places to be right now in the market. If you have to be long, these are the three places where your upside may not be as big as some of the high beta sectors, but on a relative basis, they're trading fairly well. All right, and let's do TAN. Someone's going to ask about TAN. TAN got air hold too like the rest. I thought last week if we held, could this be an impulse, consolidate, wait for it to move out, and then buy it? Well, we never got the chance. That sold off right away. And here too, you got a triple bottom here, so you got to be worried about TAN falling right out of bed. And gold. So here's gold. I owned a little bit of gold this week. One of the few bright spots. Actually, I can't even call it a bright spot of my week. But if I had to point to a bright spot, I'll say that I own a little bit of gold, but I don't have enough in it to make it really impactful. So of my 12 strategies, my favorite one, which is sectors, got hit hard. My index strategy got hit hard, and my dividend strategy had 25% cash, so it got hit. Thankfully, all the rest of my strategies were 50 to 100% in cash, so that's a little bit of a consolation, but nothing I'm going to hang my hat on. All right, let me pause and get questions, then we'll go on to commodities. John, I've never been one to put stops in, but I certainly have mental stops on a lot of stuff that I trade. Yes. Let's see. Yeah, Alan, there's a couple of the gold stuff. I didn't go through them. There's not a lot of them, but I know that Barrick looks pretty good. I like how that looks. Pan American Silver looks okay. There's certainly gold's trading okay right now. Let's see. Yeah, and Johanna and JN, yes, munis still are trading well. MUB is the muni ETF, but in the context of, so there's munis over the last year without the dividends. So if you factor in the dividends, munis are at all-time, new highs up here. But yes, munis are trading well. So this is one where someone would say, well, why don't you just buy munis, Paul? I have one of my blind spots, and I've mentioned it many times. I don't do a good job when something's already strongly in trend, in motion. I don't do well buying it up here. I like to buy things into pullbacks. I'm just not a good buyer into stretched markets. Nor am I a good seller in a stretched market. That's the worst part of what I do in running money. Those are my blind spots. But yes, munis are trading great. Let's see. Tracy, we're going to get to gold in 1 minute. Jeff as well, 1 minute. Yeah, Bill, I can't argue that the gold stocks don't look bad. My comment, which has been for 6 months, is that this is not a typical bottom in the gold stocks. I've never seen a gold stock bottom like this. Doesn't mean they can't. I'm just saying that this kind of bottom has never been seen. Now I get this is a weekly chart. So let me do the XAU because it has a longer history. So this long diffuse bottom, it's unlikely. We've never seen it before. So each time, gold stocks typically like to bottom in V fashion. So Now, in 1988, here we had a crash, and then we digested the crash for a while. So if you want to say this looks like we have now, it doesn't to me. We just don't have, all these bottoms are more V bottoms. So I don't know, guys. This is unusual. Doesn't mean it can't be the low. I'm just saying it's unusual. Dimitri, I'll pull up copper in a minute. So, all right, let's move on to commodities. So let's start with gold. Here's gold. Gun to my head, we did not see the V low from which we're going to launch the new highs. Okay, gun to my head, we did not see the low which we're going to launch the new highs. And I do think, as I mentioned forever, I think just like I have Dow 20,000 in mind as an upside unfulfilled target, I have gold 2,500 as an unfulfilled upside target. And I do think we see that sometime in 17, 18, 19. Doesn't really help us now. But smart money is really long gold. The bounce could go on for a while longer. I just don't think this is the start of the ultimate launch. The dollar, I have no new comments. Same thing. This changed my whole short-term complexion. I think the dollar's got at least 20% more on the upside, but I think we're going to go sideways for a while. We're going to really digest this huge day. Euro looks like it can go a little higher here. If Euro breaks out above 108, I will probably look to put a short on that's a little longer term. So if you're in our inner circle, that'll be a trade I'm looking at. It won't be a trade. It'll be more like an investment. And the same thing with the yen's gone a lot farther than I thought it would. I got to say that. And here's the long-term chart of the yen. If you just look at the chart, you could say, wow, this is a beautiful rounded bottom, and we're going back up, up, up on the yen. That would be really, what's the word? Cataclysmic would be an exaggeration. This would be really problematic for the global economy if the yen began to significantly appreciate. Smart money is spiking to the short side right now, which means they're usually a little early, which means the yen probably goes a little higher, but that's another one that yen goes a little higher here. I'm going to look to put on a trade for quarters, maybe a couple of years, rather than just a couple of days or a couple of weeks. But I think the yen, I've said it for a long time, I think it's going to go down another 25 to 50%. The loonie has just been decimated. Nothing new there. Decimated. And the pound also, I talked about this. I think the pound's going at least 20% lower over time. I'd love to get a rally in the pound, too, to get short. Let's see. Those are the currencies. The dollar. Bonds. TLT, I remain long in my global macro strategy, which that bailed me out because I was long. 40% of the portfolio is long TLT, and it's also long 20% of the NASDAQ. So thankfully, this balanced out owning the NASDAQ. I don't love TLT personally. I think it's going sideways, and I don't really have any comments on it. Let me look at the yield, the 10-year yield. Yeah, I mean, the 10-year on a yield chart, it looks like yields are going to go probably test 2% again, which would mean that stocks go lower too. Let's see. Oh, junk bonds. Oh, AD line. There's nothing new here. We're just kind of following the market. October lows and the August lows, still got a ways to go on the downside. But that could happen this week. So nothing there. Junk bonds, here's JNK. It's finally the kind of glimmer of hope is that in the last month it's starting to outperform the stocks. It's resisting some of the decline. Well, JNK has been decimated, as you can see. I took a 2-day trade right in here. Got in, got out. I think I lost 1/4 of 1%. And then I'll come back again and try in the next couple of weeks. But JNK's junk is just starting to outperform. It's way too early to tell if it's a real trade or not. But certainly, for the first time in a while, junk's doing okay. Here is the plain vanilla, the PIMCO fund, and it's really, so the December low, and now we're a couple of percent above it. Another indication that maybe, just maybe, we're in the early signs of a high-yield bond market bottom. I do think this year we're going to see a major high-yield bond market low, one where you can own high yield for months and months and months and quarters. But we're not there yet. Okay. So let's see. Any questions? Okay. FXA, which is the Aussie dollar. I mean, not as bad as the loonie, but still pretty bad. Smart money has been long here for a bit. EW, so I know I spoke about this a couple times. Tiny admonished me because there's a lot of firms you can't get shorts. I was talking about shorting Australia, which fell to new lows this week, as well as Brazil. And I guess there are a bunch of firms you can't get the stock to short. They're on the hard to borrow list. For what that's worth. All right, let's forge ahead. We did gold, we did the dollar, we did bonds. Let's do copper. Somebody asked about. Copper is the same. The smart money's been long it for a long time. They're clearly long and wrong and early and whatever else you want to add to it. And there's nothing there for me to comment on copper this week. Just looks ugly. Crude doesn't look as ugly. Friday was a mediocre day. Didn't do anything. Thursday we saw a hammer at new lows. So we'll see if we get some kind of bouncing crude this week. But it's hard to imagine the stock market putting in a low without crude down here. Natty Gas talked about maybe a new bull market in natural gas, and boy, bulls came alive in Natty Gas. This is what I love to see. We ended the week there, and what did I say last week? This is the kind of thing you look for: a consolidation sideways and then a breakout. Well, we had a couple of days, and that looks awfully like a flag, and then Natty Gas breaks out to the upside on Thursday and Friday. Yes, it's overbought. If this truly is the beginning of a new bull market in natural gas, it's going to get overbought and stay overbought and not let the bulls buy it at good spots. So Natty Gas is in a really interesting spot here. We've been talking about it forever. Here, they got me. They fooled me here on this move. And we fell to new lows again. And now we've got an even stronger move in natural gas. So this one should be on your, if you have to trade this stuff, Natty Gas has the potential for new bull market started. Ags, it's funny, DBA does not look great to me. Looks like a lot of other crap. But some of the commodities, wheat looks really good. I like wheat right here. A lot of good things there last week in wheat. And corn, too, looks pretty good. So wheat and corn on the plus side, they're certainly worth long trades. Beans, I like beans less, but if wheat and corn go, beans are going to go too. So you get Natty Gas and the grains look good. The soft commodities, sugar we haven't liked for a while, and It looks like it's trying to build this really diffuse top here. Smart money is definitely short sugar in a big way. Cotton's just frustrated the heck out of me. Here's where we ended last week, and I said I have absolutely no idea. And today, well, the Bears won last week, and you'd at least expect some follow through to the downside in cotton. Coffee, which is going to kill her, it still looks like nothing. You've got no volatility. You got divergences, but they're just boring the crap out of everybody. Eventually, coffee's going to make a move. I find this one very hard to take a stab at either direction right now. And cocoa, whoa. So here's cocoa. Talked about it last week. That is this either a shelf that's going to fall down, or is this bullish engulfing going to hold and we're going to go up? Well, guess what? On Monday, you found out. Boom, boom, boom. 3 days in a row of massive selling in cocoa before you put a bottom in. So cocoa should continue its bounce this week, but in the grand scheme of things, nothing going on. All right, let me see if we have Johanna, lots of divergences on sugar chart, and oh, Mr. Castics. Yeah, let's dial down. Yep, you got divergences here, there, and you got there, and there. Yep. You are right. You got plenty of divergences in sugar. No secrets there. I like it to the short side for more than just a little trade. May, I covered all of those already. So Tiny will definitely send out the recording. Any other questions, comments, concerns? Yeah, so JN said he's been doing this a long, long time, and his stomach's telling him, his gut's telling him that something big and bad is out there. Well, I don't know. We're down again. We're only down 7%. We're not down 17% yet. So, this was a market event right here. We had a 3-day pretty good decline, and now we've got kind of a similar thing building here. You may be right. I just don't think this is not a systemic or economic event. This is a market event. Markets traded poorly after this beautiful takeoff. It transitioned over. It has traded poorly, and the internals have been weak. And now China was a little catalyst that kicked it in the rear end, and I've got this little decline happening. So I would personally be really surprised if it becomes anything systemic. But could we have a larger decline like this? Absolutely. Absolutely. It's an old bull market, and doesn't take a lot to push it over some more. Jeff, I think that before we see at least a temporary low, we probably see, 16,000 in the Dow, 15.9, 15.8, and then a lot of scenarios open up. And I would want to see if and when we bottom, how we do it before I would say where we're going. But because of last week's trading, I have the worst case scenario where we could take out the August lows around 15,000. It was 15. I can't recall what the actual number is. Let's call it 15.5. and we could drop, a quick 2,000 points there. I am not saying we're going to do that. I'm just saying because of this carnage, a worst case scenario for my work opened up and it said, okay, could get pretty bad pretty quickly. Let's see what happens. Everyone's talking about the strong dollar being the culprit. I don't see it. And the dollar is in the same spot it was last month and the month before and back in March. So it's really hard for me to accept that somehow in the beginning of 2016 the dollar is the culprit. You guys would have to be a lot more convincing. Why wasn't the dollar the culprit back in here, or here, or here, or here, or here, 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 and here? But all of a sudden now it's the culprit. I don't buy it. And don't forget, in '85 and '86, the dollar was a dynamo, and stocks were going up 20% a year. I think you're reading too much into what the media is saying and believing it as the gospel. Let's see. Could it be we end up being in a large trading range bouncing up and down? May. It's unlikely because of how much the volatility has kind of blown out. Here's the VIX. A trading range, yeah, but you would really want to see that happen when the VIX settles down, not with the VIX at 27, probably going into the mid-30s. Dimitri, I agree. This is a repricing of risk, which is what I said in one of the articles. I agree with you. If the banks have so much money sitting on the sidelines, something of the financials have to go up. Well, they don't have to go up, Joanna, because that money is buffering the some of the crap they probably have loan-wise in their portfolio. I mean, the banks have done everything right fundamentally. And there's nothing wrong with the amount of energy loans they have. They're just not working out right now. It was a business decision. Some go well, some go poorly. But they got a lot of money. I don't think you're going to have problems in the Wells Fargos and the Cities and the JPs, etc. Tracy, are we starting a new bear market now? I don't think so. I'm staying on that. I don't think so. And by bear market, I assume you guys mean that this is not just a 2 or 3 month affair in a real bear market. No, I don't think so. Mike, our economy's not shrinking. Right? So we still have marginal low single-digit GDP growth. So I would argue that the economy, now you could say the economy is weakening, and I won't argue that point, Mike, but I don't think we're shrinking yet. I do not think, May, the Fed's going to go to negative interest rates. I think that is among the most distasteful things they could possibly utter. And I know Yellen mentioned it once. I just don't see the Fed going negative. And I think you'd have to get the ECB to at least a negative 1% interest rate before the Fed could even float it out there seriously. Is it not true that in a bear market moves up? Yes. So in a bull market, the declines are elevator shaft and the rallies are stair step. In a bear market, it's the other way around. We stair step down and the rallies are fast and furious. That is true, Johanna. Michelle, we're in a bear market, right? Yeah, I don't agree. And maybe I'm the last man standing. But I don't think we're in a bear market yet. Maybe I'm like an ostrich and my head's buried in the sand. But I don't think it's yet. I think the risk is a market event, or worst case is we go down, I don't know, 2,500 point worst case from here. And I say that rather cavalierly. That would really suck and hurt. But then I think we would just turn tail and go right back to all-time highs. Latest Fed speaker said no more help for stocks. Well, Bill, they didn't say that exactly. And also, let's not forget, you can discount most of what those knuckleheads say. Remember, Bernanke in March of 2007 said, subprime was contained, no spillover, don't worry. And then as late as the first quarter of 2008, they were saying, all is well, no recession. So the fact that they're saying no more help for stocks, well, they have to say that because they're raising interest rates. So I would discount a lot of what the Fed had to say. The death cross, John, actually doesn't bear out numbers-wise. The death cross, when the 50-day moving average turns below the 200-day moving average, that has positive results going forward over history. Does not bear out as a good timing indicator. Tracy wants to know, well, Tracy, to me, we're going to see if and when we get some kind of low put in, which should be sooner than later because of how fast we're declining. May said, I heard subprime and auto loans is not doing well. There's a big difference, don't forget, between not doing well, because loans ebb and flow, and what we saw in 2008, where everyone defaulted and there were write-downs. Subprime and auto is still, in my view, a great business to be in. Now maybe at the end of this last little boom, the covenants got a little light, but no one's lending money hand over fist. So you don't have the exposure. The loans that are on the books may not be in great shape, but they're a fraction of the size they were in 2008. So these lenders and the auto companies can certainly withstand loans going bad. It's a very different environment than it was in 2008. Very, very, very different. All right, anything else? This is a good discussion. I like when you guys throw this stuff out. Michelle, I mean, subprime and junk aren't the same, but if I had to kind of give an analogy, yes, they're the same. Subprime, it's the rating agencies have a different role, but they're good comps. So a junk bond and a subprime loan lender are probably good comparisons, but they're not the same in how the actual loans are done, if that makes any sense. All right, anything else? Last call. Good discussion. Loans on the other hand for a group of energy stocks will be on the bad side. That's right, but not all loans, don't forget, Johanna. I mean, the lenders, the people borrowed money, Exxon and Chevron and Schlumberger and Halliburton, Baker Hughes. Just because oil is down, they're not going to default. What you're talking about, the secondary, the mid-energy companies in the country are going to have problems, but the big ones, they're going to be fine. Yes, Jeff, right. Stop loss orders and good to cancel orders are being removed. Yeah, Michelle, I have not seen the movie The Big Short. I read the book the week it came out, but it's on my list of movies to see. I love movies, but since my wife and I had our kids, we end up making lists and then watching them on demand. But I will see The Big Short, hopefully sooner than later, because it's ski season. Talk about horrible being married to me as is, but during ski season, I don't let my wife make any plans on Friday and Saturday because everything is subject to ski conditions. If it's good, I'm going north, and if it's crummy, then maybe I'll stay home and make a last-minute plan to go out with friends. So nobody likes that. But as you know about me, I don't really care what anybody else thinks. I do my own thing. So this weekend I took my youngest, who's our hardiest and the best skier in the family of the kids. I don't know how he got to that, but I will go to the Big Short. Anybody else? Okay. Have a good week. Buckle up, put your helmets on. It's going to be a wild week and a fast week. So keep some powder dry. Hopefully you're doing a little better than I did last week. And have a good one. And Tiny and I will catch you if all goes well. Oh, next week's a holiday. So thank you, Johanna. My back, I went to physical therapy 3 days last week, and seriously, I think it's a miracle. My back felt great skiing yesterday. My back, I could stand straight up. I could ski. I skied the bumps. So I thank you. I feel great. Just gotta get the market. I just gotta get myself in line with the market, make some money. I certainly did a good job losing money this week. All right. We'll see you next week. Thanks for coming.